Okay, our next reading is understanding the balance sheet. First things, we've been asked to describe the elements of a balance sheet, in particular assets, liabilities and equity. So here we have a classic balance sheet here. This balance sheet is actually known as account format because it has the assets on the left and the liabilities and equity on the right. So you can see we've got current assets and long-lived assets, i.e. we're distinguishing between the assets that are going to be either cash or convertible into cash within the next operating cycle, and long-lived assets, the infrastructure in which the company is operating from. We've then got our liabilities and equity. Liabilities being amounts that are due within the next operating cycle. Long-term liabilities, amounts falling due after that. And then remember, the definition of a liability is an amount owed to a third party. Then we've got our residual, our owner's equity. Contributed capital would comprise of two elements: the common stock issued at par and any additional paid in capital. And then we've got our retained earnings there. Now remember, the retained earnings are a key here. They're the linkage between the income statement and the balance sheet. Remember, every year we take that year's net income, subtract a dividend if we're going to pay a dividend. Investment property that we see under IFRS but not US GAAP, typically being often, as it says, property, real estate, held for its investment potential, capital gains and income, for example. Intangible assets, assets that do not have any physical form, so you can't touch, fondle and feel them. Equity accounted investments, well, that's something to do with joint ventures and associates. Now, associates are companies where we have an influence but not outright control, and we're going to look at the detailed accounting of this at level 2. So equity accounted investments represents associates and joint ventures. Note that the US phrase that you sometimes hear for associate is affiliate, meaning exactly the same thing. Natural resources, where we've gone out and bought natural resources like oil fields, etc. And assets held for sale. Well, when we look at our PP&E, our investment property, our intangibles, we refer to these as assets held for use. We're going to continue to use these in order to run our business. Assets held for sale, however, are assets that were held for use where we've made the decision that we are going to dispose of them in the future. So at that point, they come out of assets held for use and go into assets held for sale, and we stop depreciating them at that point. Let's have a look at our liabilities. Remember, we defined liabilities as amounts owed to third parties rather than the shareholders. So a liability recognition is going to be a probable sacrifice of future economic benefits, i.e. cash flows leaving the company. Notice our second bullet point says amounts received but not reported as revenue in the income statement, deferred or unearned revenue. Well, let's define that a little bit clearer for you. Let's imagine that a customer has paid you, but you've not yet completed the earnings activity, so you can't record a sale in the income statement. Where does that balance go? Well, it goes in as a liability, indicating that you still have earning activities to complete before you can record the sale. So it's when customers pay you in advance of revenue recognition. And our final point says amounts reported as expenses which have not been paid. Amounts reported as expenses that have not been paid, typically we're going to refer to these as accruals. Okay, now all of you will have an accrual. Typically you have an accrual each month for your telephone. You've made calls on it, but you've not yet received an invoice. Therefore you have to estimate the cost and include it in this year's income statement and record a liability. So let's have a look at some of our classic items, therefore, that we're likely to expect to see in liabilities. Bank borrowings, i.e. overdrawn bank accounts and loans. Notes payable. These are just short-term interest-bearing debt, i.e. interest-bearing debt with a maturity of less than 12 months. Traditionally, these were often linked to your accounts or were linked to amounts that you owed your suppliers, and essentially you went back to your supplier and said, look, I can't pay you right now, I'd like to extend my credit terms, and they'd say yes, but we're going to start charging you interest, and rather than treating it as an account payable, it got treated as notes payable. But anyway, short-term debt instruments is all. You're likely to find these when you look in the accounts of big investment companies. So if you look at the accounts of an investment bank, you're going to see trading securities. Available for sale securities. Definition of these are securities that may be disposed of for liquidity purposes. Both trading and available for sale securities are going to be held at their fair value. Okay, so in other words, they're not recorded at historic cost, purchase price, they're recorded at fair value, their current market value. Now, derivatives, again, will be recorded at fair value, whether that is a naked derivative, i.e. standalone, pure for speculative purposes, or whether it's embedded in a non-derivative instrument, such as a bond with an equity call feature, a callable convertible bond. Notice as well, assets with fair value exposures hedged by derivatives will also be recorded at fair value. It makes sense. If you're recording the derivative at fair value, well, it's the gains and losses in the derivative should offset the gains and losses on the asset, of course. So therefore, both need to be recorded at fair value. Financial liabilities, again, could be derivatives, and again, any liabilities where we're hedging their fair value using derivatives, again, should be reported at fair value. Again, remember, the gain or loss on the liability here should be offset by the gain or loss on the asset. Cost or amortized cost. Now, remember, when we talk about cost, we're typically talking about purchase price and any costs involved in getting the asset into location and working condition. So for financial assets, it's unlisted instruments under US GAAP. So fine, unlisted debt and equity. Held to maturity investments. Now these are actually at amortized cost. If you have held to maturity investments, essentially, then originally they're recorded at purchase price, but we then amortize any premium or discount. This has the effect of changing the asset's value to par value over its life. So if you bought a bond at a discount, it will slowly migrate to par over its life. If you bought a bond at a premium, then it's going to slowly come down to par value over its life. Again, we're going to look at a lot of treatment on this in the Level 2 syllabus, but we'll see a little bit at Level 1. Held to maturity only applies to debt instruments where you have the intent and the ability to hold it to maturity. Bank loans are typically reported at costs, and receivables, i.e. amounts owed by our customers, of course, are going to be at cost, what they owe us, net, of course, of any bad or doubtful debt provision. Financial liabilities, again, are typically at amortized cost. Let's take that view, the view of bonds again. Remember, it's just the same as the unlisted it's just the same as the held to maturity investments. If you issue bonds, if you issue at a discount, initially it sits there below par and then will increase to par over the bond's life. If you issue the bond at a premium, then it's going to decrease to par over the bond's life. Because you can sustain current ratios that are less than 1, but only if you collect cash from your customers before you pay your suppliers. So in other words, you have a negative cash operating cycle. Again, don't worry, we'll come back to this later. Quick ratio just adjusts the current ratio for an illiquid current asset. And that illiquid current asset is inventory, not very liquid. First of all, you've got the raw materials. First of all, you have to produce the good. Then you have to sell the good. Then you have to wait for the customer to pay. So there's a long lag between having raw materials or inventory and cash. So we're just reassessing liquidity, ignoring the most illiquid of our current assets. Finally, the cash ratio, which looks at cash and marketable securities, so any listed securities that could be sold, over current liabilities. Solvency ratios, remember, are more to do with your capital structure, so debt to equity. So the first one is long-term debt to equity, where we look at total long-term debt over total equity. Now, total long-term debt is deemed to be all liabilities falling due after more than 12 months, over total equity, which is all of our stockholders' equity items. Okay, so in other words, the common stock, the preferred stock, the additional paid-in capital, the retained earnings, and the comprehensive income items. Now, let's have a look at our debt to equity. This is the most common one. Total debt over total equity. You need to know the definition of total debt. It's all of your long-term liabilities plus any interest-bearing current liabilities. Okay, over total equity. Total debt over assets, again, total debt, remember, all long-term liabilities plus interest-bearing current liabilities over your total assets, and then financial leverage multiplier, which we're going to see in DuPont analysis later on, total assets over total equity. Again, basic idea with the financial leverage multiplier is that if the asset purchases were being financed from equity rather than issuing any debt, then the ratio would be close to 1. Once you start to finance asset purchases, whether that's long-lived assets or working capital, using debt, then assets are going to increase, equity will be unaffected, the ratio will start to increase beyond 1.